Hey everyone, we are back. Chapter 10, Standard Costing and Variance Analysis. This is learning objective number 3. We're going to be computing the direct labor rate and efficiency variances and discussing their significance. So similar to learning objective number 2, where we looked at the materials, now we're going to be looking at direct labor. Okay, so friendly reminder that standard costs are the benchmarks or norms where we have our quantity standards and our cost price standards. Our quantity standards specify how much of an input should be used to make a product or provide a service, whereas our cost price standards specify how much should be paid for each unit of the input. Let's take a look at an example that we're going to go through together. And it's Glacier Peaks. They're back and they have the following direct labor standards for its mountain parka. 0.6 standard hours per parka at 20 per hour, where last month employees actually worked 1,250 hours at a total labor cost of $26,250 to make the same 2,000 parkas that we looked at in learning objective number 2's video. All right, so let us meet each other in Excel and go through and calculate the two variances. Okay, so let us look at our two different variances. First, let's look at our labor rate variance and calculate that. So again, our rates are going to be the same as prices, and we have it equal to our actual quantity times by our actual price minus our standard price. So let us calculate our inputs over here. Boop. Boop. We need our actual quantity, actual quantity, actual price, and our standard price. So we actually used 1,250 hours and at a rate or price of, let's see, our standard price would be $20 per hour. And then we have to calculate actually how many hours we used, because we had, let's see, our 26,250 divided by the 1,250 hours that were incurred. Did I put an equals there? No, I did not. Let's do that now to get $21 per hour of labor costs used. Cool. All right, labor rate variance is equal to actual quantity times AP less SP equals 1,250. So actual price is greater than standard price, therefore this is going to be an unfavorable variance. All right, let's look at our labor efficiency variance, our LRV, and this is going to be equal to our standard price times by our AQ minus our SQ. All right, so let us get those items over here, SP, AQ, SQ, and our standard price is going to be the same as what we encountered over here, and our actual quantity of hours is going to be 1,250. And then we are going to look and let's see, we have 0.6 standard hours per parka, and we actually made 2,000 parkas. So our standard quantity is going to be equal to 0.6 times 2,000 equals 1,200. And let's plug this in. Our standard price times by AQ minus SQ. And we get a variance of 1,000. So let's see, we actually used more than we thought we were going to use. So this is going to be unfavorable as well. All right, well, together then our total flexible budget variance is going to be our labor rate variance plus, whoops, why did I, boom, boom, under, okay. It's going to be equal to our labor rate variance plus our labor efficiency variance, and that's going to be a total variance of 2,250. Negative, unfavorable. We spent and used more than we thought we were going to use, and that's going to decrease, our profits, our expected profits by $2,250. Just over, I think that was last month. Gosh, yeah, last month. All right, not awesome news. Let's go back to the slides. All right, so let us do this again, but let's look at Hanson. And so they are making a zippy, whatever that is. Feel free to pause the video. In fact, I encourage you to pause the video, calculate the LRV, and also consider calculating the LEV, the labor rate variance and the labor efficiency variance. And we'll go over it in Excel together a little bit quicker than last time, and then we'll have some closing summary items, and then that is it for chapter 10. So thank you for sticking with me. Let's go through this example. Pause the video now, please. All right, Hanson, let's figure out your LRV. Let us figure out your LEV, labor efficiency variance. Okay, and so you are going to equal to our AQ times AP minus SP. Okay. And yeah, let us get our inputs. Do you want to just have one more? Let's insert one, but then yeah, we lose that, but let's just move it over a little bit. Cool. Okay, and we'll go down one. So where we have AQ, we have AP, and we have SP, and we are going to be looking at our various items here. All right, so we actually used 775 direct labor hours, so our AQ for labor hours is 775, and then we had a total cost of, so our actual price is equal to our 18,910 divided by our 775 labor hours incurred equals 2440. We plan to have a standard price of $24 per hour, so we already know here, spent more than we thought, but let's do the calculation. So our actual quantity, 775 times by 2440 minus 24, and that gives us a variance of $310, and that is going to be unfavorable because we spent more than we thought we were going to spend. All right, so okay, and over here, LEV, let's calculate that. That is going to be equal to our standard price times by our AQ minus, AQ minus SQ, yep, because we're isolating to find out the difference of the quantity. And let's see, we need to have SP, we need to have AQ, we need to have SQ. Fabulous. Our SP is going to be the same standard price as we had over here. And let us think about this. We have our actual quantity. We use 775 direct labor hours, 0.75 standard hours, and we made 1,000 zippies. So we can go boom, 0.75 times 1,000. And so we have standard quantity of 750, so we used actual more. So we already know this is going to be bad news. This is going to be unfavorable. But let's map this out. Standard price times by actual quantity minus standard quantity. And that gives us a 600 unfavorable variance. And overall, so 600 unfavorable. So in case you're following along at home, or I had calculated this before, the first one is going to be A, unfavorable, and this one's going to be C, unfavorable. And then just for funsies, our total flexible budget variance is going to be bad news overall of $750. Pardon me, sorry. 310 plus 750 equals 1060. So yeah, not good news. Definitely want to talk with all the parties responsible for these inputs and figure out what went wrong there. Okay. Going back to the slides. That's it, people. That is chapter 10. These are our standards, where a standard is a benchmark or norm for measuring performance. Standards are set for both cost and quantity of inputs needed to manufacture goods or to provide services. These standards are normally practical in nature, meaning that they can be attained by reasonable and highly efficient effort, but not perfect. The difference between actual cost and standard cost is referred to as a variance. The denominator of the activity is used to calculate the predetermined overhead rate for variable and fixed overhead, though that is outside the scope of this course. And so understanding overall what we saw in learning objective number 1, where we have our AQ and our actual price variance and our standards, understanding how kind of the grid works out. Let me just pull this up real quick. Understanding how we have on one side what actually happened, what we thought was going to happen, and then what would the price have been if we knew what we were actually going to produce. That helps us pick apart what happened to our price, what happened to our quantity, and to figure out what happened overall so that we can inquire with our managers and get to the bottom so that ultimately we can fix it and increase our profits in future periods, or at least not repeat the same mistakes and learn from them. People, thank you so much for your time and attention. I will see you next week in the mini lecture videos there. Take care.